Hey everyone, it's Matt Donaghue with Mission Financial Planners. It is Cinco de Mayo, May 5th. Let's jump into our weekly market update. Well, this last week gave us a lot to chew on. Not all of it was appetizing, though. So GDP contracted, consumer confidence dropped, but job growth remained strong. So are we headed for a slowdown, or are we just getting whiplash from some policy changes? Let's break it down and talk about some opportunities that can come with this uncertainty. First of all, US GDP shrank by about 0.3% in the first quarter of 2025. Big reason, it was because of the spike in imports triggered by the new tariffs. Meanwhile, consumer confidence fell to 86, and that's not great, but it's not a collapse in consumer confidence either. And yet the labor market is still chugging along. Employers added 177,000 jobs in April and nearly 400,000 for the first quarter. So the bottom line is the economy is not in free fall, but productivity may be kind of slipping a little bit, and that might matter more than most people realize. Productivity is how much output we get per hour's worked. So it's a key driver of corporate profits, and it's under a lot of pressure. Tariffs, immigration restrictions, policy uncertainty, they are all making businesses less efficient. More than 60 companies have already revised down earnings guidance this quarter, and that is the most since 2014. If productivity continues to lag, profit margins will shrink, and that could derail expectations of 9% earnings growth this year. So we as investors all need to watch this and pay attention to it. So let's shift gears for a second, though. This gets into a little Stoic wisdom, and really it comes down to this. This is a nice breakdown of this quote. It's first digest your theories, then show us your reasoned choices. So in other words, don't just talk smart, act smart. And whether you're managing a portfolio, planning retirement, leading a business, just going about your day to day, your actions should reflect your discipline and your values, especially, and I would say critically, when things get rocky. So here's building on that kind of let's just make good decisions mindset. Here's some smart tax moves for you as well. Check your cost basis on everything you have. When you sell an asset, stocks, real estate, inherited property, your tax bill is based on the difference between your sale price and your basis. If you get the basis wrong, then you'll overpay in terms of taxes. So reinvested dividends, gifted assets, business equipment, all this stuff, your basis matters. If you had capital losses this year, you might be able to deduct up to $3,000 against your income, and then you could carry the rest into future years. But you have to report it correctly. Make sure you do that on IRS Form 8949, and you're going to have to file a Schedule D as well. Keep good records, track your basis. It isn't glamorous, but it is smart tax planning. Speaking of tax planning, here's 4 different ways that you can go about reducing your required minimum distribution. Now, this is super important. We see this a lot. People will save, and like their 401k at work. And then when they get to retirement age, they're like, oh my gosh, what do you mean? I have too much money and I don't need to take out this much this year, but the IRS is telling me I have to take out money. That's what a required minimum distribution is. When you take the money out of your traditional IRA or 401k or 403b or 457, any of those things, what happens is every last dollar you take out is taxable to you, whether you need the money or not, because the IRS will impose penalties on you if you don't take out the minimums. So here's a couple ideas for how to reduce them. First thing is, don't wait. In your early retirement years, I know it's going to feel counterintuitive to hear this, but in many cases it makes sense to draw down those IRAs to minimize the tax burden later. Second thing, serial Roth conversions. Check out our blog post this week that gets into what that means. But serial Roth conversions, don't just do it quarterly, don't just do it sporadically, do it over a real long period of time. Real tax planning looks at your lifetime tax rate, not just your annual tax rate. Qualified charitable distributions, also known as QCDs, they let you give directly from your IRA up to $100,000 per year tax-free. That's a win-win for you and the charity. And finally, QLACs, qualified longevity annuity contracts. These things can live in your IRA or your 401k, and they let you defer income to age 85, reduce your IRA balance now, and create guaranteed income for late in life, just in case you're thinking, hey, what if I live to 105? So thanks to the Secure Act 2.0 and higher interest rates, the payouts on the QLACs are actually better than ever. Each of these can reduce future taxes and boost flexibility, but they take a little bit of planning. So yes, growth is slowing, policy's uncertain, but that's exactly when strategy matters the most. This is not about reacting to every single data point. It's about staying grounded, informed, and disciplined. As the Stoics teach us, knowledge means nothing without action. And as history teaches us, fortune, favors the prepared. Let's make sure your financial strategy is ready for whatever comes next. If you have any questions, you want to review your plan, let's talk. You can always get a hold of us. Just go to our website, missionfinancialplanners.com, or reach out directly at 888-339-0093. Once again, 888-339-0093. Have a great Cinco de Mayo. Have a great week, and we'll see you next week.